Tactic trading plans can be used by both short-term and long-term investors. An investor who uses automatic investing would typically purchase securities at regular intervals. At the same time, a tactical trader would typically enter or exit positions at exact price levels or when certain conditions are met. A tactical trading plan is, therefore, much more detailed because of this. Tactical traders must establish specific rules regarding when they will enter a trade. Various factors can contribute to this, including chart patterns, price movements at certain levels, technical indicator signals, statistical bias, and more. An exit strategy must also be included in the tactical trading plan. A profit making exit is one option, or you can get out with a loss. A tactical trader will often use limit orders if they want to take profits or stop orders if they want to exit losses. As part of the trading plan, you will also know how much capital you will risk on each trade, as well as how you will determine the position size. It may also be necessary to add additional rules that specify when trading is acceptable and when it is not. For example, there may not be enough movement or opportunities for day traders if volatility falls below a certain level. It does not matter if their entry criteria are met. If volatility is below a certain level, they will not trade.